Welcome to the Future of Money podcast. I'm Alex, and with me, as always, is my curious and insightful co host, Rowan.
Hey everyone, I'm excited about today's topic. I've been seeing these buy now, pay later buttons everywhere lately.
That's actually perfect timing, Rowan, because today we're diving into something that affects literally everyone who's ever borrowed money. You know how sometimes you hear those stories about people who took out a small loan and somehow, years later, they've paid back three times the amount but still owe more than they started with?
Wow, that sounds terrifying. How does that even happen?
Well, we're looking at a massive shift in how lending works. Traditional banks are stepping back, and this whole new world of private credit has exploded to $1.5 trillion in 2024.
1.5 trillion? That's a lot of zeros.
It sure is. And today we're pulling back the curtain on this transformation. We'll explore how new lending platforms are changing the game, why younger borrowers are getting caught in sophisticated debt traps, and what it might mean for our financial future.
I've got to say, I'm a bit nervous about what we're going to uncover here.
You should be. This isn't just about numbers. It's about real people and a system that's fundamentally reshaping how we all deal with money. Let me take you back to what happened after the 2008 financial crisis. Banks used to be the go to place for almost any kind of loan, but something really interesting started happening around 2015.
2015? That's quite a while after the crisis. What changed?
That's when these new regulations called Basel III came into effect. They basically told banks they needed to keep more money in reserve when making certain types of loans.
So the banks had to keep more money in their vaults? Why is that such a big deal?
Think of it like this. If a bank has $100 and they need to keep $50 in reserve instead of $20, that's 30 fewer dollars they can lend out. It made a lot of traditional lending just not worth it for them anymore.
Oh, I get it. So the banks started saying no to loans they would have approved before?
Exactly. And nature abhors a vacuum, right? As banks stepped back, private lenders stepped in. These are investment funds, private equity firms, even technology companies. They saw an opportunity and they took it.
But these private lenders, they don't have the same rules as banks, do they?
Not even close. They operate under completely different regulations. They can be more flexible, move faster, and take on riskier loans. But here's the catch, they charge a lot more.
So we've created this kind of two-tier system where some people can still get bank loans, but others have to go to these more expensive lenders?
That's exactly what happened. And it's created this fascinating situation where we now have traditional banks mostly lending to their preferred customers. You know, the ones with perfect credit scores, stable jobs, lots of assets.
And everyone else?
They're left with these alternative lenders who might charge interest rates that would make your eyes water. We're talking rates that can be 3 or 4 times what a traditional bank would charge.
This feels like we're going backwards. Wasn't the whole point of banking regulation to protect people?
You'd think so, but it's had this unintended consequence. The regulations made banks safer, but they also pushed a lot of lending into this shadow banking system that's far less regulated.
I've actually noticed this. Even some big stores now have their own credit cards and payment plans. Is that part of this trend?
100%. These companies realized they could make money not just by selling products, but by financing them too. And because they're not technically banks, they can charge much higher rates.
So what happens to someone who can't get a traditional bank loan nowadays?
Well, they might start with a buy now, pay later loan, then maybe take out a high interest personal loan to consolidate some debt. And before they know it, they're stuck in this cycle of increasingly expensive borrowing.
That sounds like a recipe for disaster. Are we seeing more people getting caught in these debt traps?
The numbers are pretty concerning. By 2024, private credit hit $1.5 trillion. That's not just big companies borrowing. That's regular people taking out loans at much higher rates than they would have paid 15 years ago.
1.5 trillion. I still can't wrap my head around that number. How many zeros is that again?
12 zeros. But what's really important isn't the size, it's how fast it grew. In 2015, it was less than half that amount.
That's a massive change in less than 10 years.
And it's fundamentally changed how money flows through our economy. We've created this whole new financial ecosystem that operates alongside traditional banking, but with very different rules and much higher costs. You know what's fascinating about all this, Rowan? The technology that was supposed to democratize lending might actually be making things worse.
Really? But I thought fintech was all about making things easier and more accessible.
That's what makes it so interesting and concerning. When the pandemic hit, we saw this massive surge in digital lending. Everyone was stuck at home, doing everything online, and these fintech companies were ready with slick apps and instant approvals.
Oh yeah, I remember. Suddenly you could get a loan without ever talking to anyone. Just tap a few buttons and money appears?
Exactly. But here's where it gets tricky. These apps are designed to be as frictionless as possible. They're using what behavioral scientists call dark patterns, interface designs that make it super easy to borrow, but really hard to understand the true costs.
Wait, what do you mean by dark patterns?
Think about buy now, pay later apps. They show you these tiny installment payments, like 4 easy payments of $25. Sounds manageable, right?
Sure, I mean, who can't afford $25?
But they don't prominently display the annual percentage rate. They don't show you what happens if you miss a payment. And they definitely don't tell you that their data shows people who use buy now, pay later tend to spend 40% more than they would otherwise.
40% more? That's that's actually kind of scary. Are they targeting specific groups?
The data shows these services are particularly popular with Gen Z and younger millennials. In fact, 70% of buy now, pay later users are under 44 years old.
I'm guessing that's not a coincidence.
Not at all. These companies are masters at social media marketing. They partner with influencers, that they embed themselves in online shopping, and they know exactly how to appeal to younger users who might be intimidated by traditional banking.
So what's that? What happens when people can't pay?
That's where things get really aggressive. These companies might use automated systems that bombard people with texts, emails, and phone calls. Some even use social media to contact people about their debts.
They can do that? That seems incredibly invasive.
And it gets worse. Many of these platforms have what they call dynamic repayment options. Sounds helpful, right? But what they're really doing is offering to extend your loan with extra fees and interest, of course.
So they're basically offering you a way to dig yourself deeper into debt?
Precisely. And because everything's automated, there's no human to talk to about your situation, no way to explain that you lost your job or had a medical emergency.
I've got to say, this is making traditional banks sound pretty good in comparison.
That's the irony, isn't it? These fintech companies promise to fix everything wrong with traditional banking. Instead, they've created new problems. Like, how about this? Some of these platforms are now using artificial intelligence to approve loans in seconds.
That sounds efficient. But I'm sensing there's a catch.
The catch is these AI systems are making decisions based on all sorts of non traditional data. Your social media activity, what time of day you're applying for the loan, even how quickly you scroll through their terms and conditions.
Hold on. So if I apply for a loan at 3 in the morning, scrolling quickly through the terms,
The AI might decide you're desperate and risky, or it might decide you're exactly the kind of borrower they want. Someone who makes quick decisions and might not read the fine print.
I feel like we're watching the creation of a whole new kind of predatory lending.
And it's happening at a scale we've never seen before. These companies can reach millions of potential borrowers with virtually no overhead costs. They're not building branches or hiring loan officers, they're just deploying code.
It's like we've automated the debt trap.
That's actually a perfect way to put it. We've created this incredibly efficient system for getting people into debt, but we haven't really thought about how to help them get out of it. You know what's really eye opening? Let's look at how these loans actually work under the hood. The interest rates you see advertised, that's just the beginning.
What do you mean? Isn't the interest rate pretty straightforward?
That's exactly what lenders want you to think. Let me walk you through a typical example. Say you need to borrow $400 for an emergency car repair.
Okay, seems reasonable enough.
The lender might advertise this as a simple 15% interest rate. Sounds much better than a credit card, right? But here's where it gets tricky. That 15%, it's not annual, it's for just 2 weeks.
2 weeks? So if you do the math, that would be
If you calculate the annual percentage rate, it works out to around 390%. And that's before we even talk about the fees.
fees. What kind of fees are we talking about?
Oh, there are some creative ones. There's the origination fee, processing fee, administrative fee. I've even seen something called a documentation verification fee.
Documentation verification fee? That sounds like charging someone to look at their paperwork.
Exactly. And here's where it gets really sophisticated. Some lenders now use what they call tiered late fees. Miss your payment by 1 day? That's a $30 fee. 3 days, $50. A week? Now we're talking $75.
So the fees can end up being more than the original loan?
Much more. And here's another trick. Some lenders have started using what they call convenience fees. Want to pay your loan online? That's a fee. Want to pay by phone? That's another fee. Want to pay with a debit card? You guessed it.
But how is this even legal?
Because technically they're not charging interest, they're charging fees for services. And get this, some lenders now use artificial intelligence to calculate the optimal fee structure for each borrower.
What do you mean optimal? Optimal for who?
Optimal for maximizing their profit while keeping the borrower just able to make minimum payments. The AI analyzes your payment history, spending patterns, even your social media activity to determine exactly how much they can charge without pushing you into default.
That's that's actually kind of terrifying. They're basically calculating exactly how much they can squeeze out of each person.
And it gets even more sophisticated. Some lenders now offer what they call dynamic repayment schedules. They'll actually adjust your due dates based on your paycheck schedule
Well, that sounds helpful at least.
until you realize they're timing it so your payment is due just before your paycheck hits. If you're running a little short that week and miss the payment, boom, more fees.
So they're basically setting people up to fail?
The numbers suggest that's exactly what's happening. The average borrower ends up paying more than twice the original loan amount in fees and interest. And about 80% of these loans get rolled over into new loans.
Rolled over? What does that mean exactly?
It means when you can't pay, they offer to give you a new loan to pay off the old one. Of course, that new loan comes with its own fees and interest. I've seen cases where people borrowed $500 and ended up paying back over $3,000.
$3,000 on a $500 loan? That's 6 times the original amount.
And what's really concerning is how these lenders are using technology to make this all seem normal. They send friendly push notifications, offer rewards programs, even gamify the borrowing experience.
Gamify? Like turning debt into some kind of game?
Exactly. Some apps now give you points or badges for making payments on time. They create these elaborate reward systems that make you feel like you're winning while you're actually paying hundreds or thousands in fees.
It's like they've turned predatory lending into a science.
That's because they have. They're using big data, behavioral psychology, and artificial intelligence to perfect the art of extracting maximum profit from each borrower. You know what keeps me up at night about all this, Rowan? We're watching an entire generation's financial future transform before our eyes, and not in a good way.
What do you mean? Are we talking about specific age groups being hit harder?
The numbers are pretty stark. People under 35 are now 3 times more likely to file for bankruptcy than their parents were at the same age. And it's not just because they're bad with money.
3 times more likely? That can't just be about avocado toast and fancy coffee.
Not at all. We're seeing this perfect storm where younger people are facing stagnant wages, rising living costs, and now these sophisticated lending traps. The average 25-year-old today has 40% more debt than their parents did at that age.
I've noticed something interesting too. My social media feed is full of these finance influencers giving advice about debt, but a lot of them are actually promoting these lending products.
That's a huge part of the problem. These companies are spending billions on social media marketing. They're paying influencers to make debt seem normal, even cool.
Wait, so they're actually marketing debt as a lifestyle choice?
Exactly. And it's working. Studies show that 78% of Gen Z and younger millennials now view debt as just a normal part of life. They don't even expect to ever be debt free.
That's actually heartbreaking. We're basically conditioning young people to accept perpetual debt.
And here's where it gets really concerning. The average credit score for people under 30 has dropped 40 points since 2020. That's the sharpest decline of any age group in history.
So they're starting their adult lives with this financial anchor around their necks?
And it's affecting everything. The average age of first-time homebuyers has jumped to 38. People are delaying having children, putting off starting businesses. Some are even skipping necessary medical care because they're already drowning in debt.
This sounds like it could have huge long-term consequences for society.
We're already seeing them. Surveys show 65% of young adults say they can't even think about saving for retirement because they're just trying to manage their current debt payments.
But surely there must be some solutions? Some way to break this cycle?
That's the thing. These lending platforms are so sophisticated now, they can spot when someone's trying to escape the debt cycle. They'll suddenly offer debt consolidation loans or special refinancing deals.
Those sound helpful, though?
On the surface, yes, but they often just reset the clock on the debt, adding new fees and extending the repayment period. It's like being offered a bigger shovel when you're already in a hole.
So we've got an entire generation that might never experience financial freedom?
Unless something changes dramatically, we're looking at what some economists are calling a debt apartheid. You'll have people who got their start before this system took hold, and then everyone else.
That's going to affect everything from housing markets to retirement systems, isn't it?
Absolutely. We're already seeing the ripple effects. The average retirement age is projected to hit 72 by 2040. Not because people want to work longer, but because they'll have no choice.
72? That's not retirement. That's working until you physically can't anymore.
And that's assuming they can maintain steady employment that long. The really tragic part is how this debt burden is limiting people's ability to adapt and retrain for new careers.
Because they can't afford to take time off or pay for additional education?
Exactly. We're creating this locked in workforce that can't afford to take risks or make changes. They're stuck servicing debt instead of building futures. You know what really keeps regulators awake at night? All these individual debt stories we've been talking about, they're actually building up to something much bigger and potentially devastating.
What do you mean? Like some kind of financial avalanche?
That's actually a perfect metaphor, just like how tiny shifts in snow can trigger an avalanche. All these individual debt situations are creating unstable conditions in our financial system.
But we've got regulations now, right? After 2008, everything was supposed to be safer.
Here's the thing. Remember how we talked about all that lending moving outside traditional banks? Well, by 2025, private credit markets have become so interconnected that a problem in one area could rapidly spread everywhere.
Like a game of financial dominoes?
Exactly. Let me give you a concrete example. These buy now, pay later companies, they don't actually hold most of their loans. They package them up and sell them to investors.
Oh, that sounds familiar. Wasn't that part of what happened in 2008 with mortgages?
You're catching on. But here's where it gets really concerning. These loans are being bundled into something called collateralized loan obligations, and guess who's buying them? Pension funds, insurance companies, even the banks that stepped back from direct lending.
So, if people start defaulting on their loans,
It wouldn't just affect the lending companies. It could hit retirement accounts, insurance rates, even the ability of banks to make traditional loans. And here's the scary part. Default rates are already creeping up.
how bad are we talking?
In certain segments of private credit, default rates have tripled in the past 18 months. We're seeing especially concerning numbers in student loan refinancing and buy now, pay later services.
That sounds like a pretty serious warning sign.
And it gets worse. Because these loans are spread across so many different types of investors, nobody really knows exactly where all the risk is concentrated. It's like having a time bomb, but the timer is hidden.
So, we don't even know where the problems might show up first?
Regulators are particularly worried about what they call shadow banking interconnections. When one part of the system starts to fail, it could trigger a cascade of problems that nobody saw coming.
I've got to ask, how close are we to something breaking?
Some analysts are pointing to what they call the 2026 problem. That's when a huge wave of these private credit loans starts coming due for refinancing. If interest rates are still high, then
Oh, wow. So, we might be sitting on a financial time bomb that's already ticking.
the Federal Reserve has actually started tracking what they call systemic risk indicators in private credit markets. They're seeing patterns that look uncomfortably similar to 2007.
But surely we've learned from that crisis. We won't make the same mistakes again?
That's the thing about financial innovation, Rowan. We never make exactly the same mistakes. We make new ones. And this time, the system is even more complex and interconnected than it was before.
And I'm guessing when things go wrong, it's not the big financial companies that suffer the most?
Unfortunately, you're right. If this system does crack, it's regular people who will feel it first and worst. We're talking about potential job losses, retirement accounts taking hits, and even harder access to credit just when people might need it most.
It feels like we're watching a slow motion car crash that nobody can stop.
The really frustrating part is that we can see it coming. Regulators, economists, even some industry insiders are raising red flags, but the profits are so massive that nobody wants to be the first to step back. You know, Rowan, after diving deep into this world of modern lending, I can't help but feel we're at a crucial turning point in financial history.
It's pretty eye opening how something as simple as borrowing money has become so complex and potentially dangerous.
And that's really the heart of it. We've created this incredibly sophisticated system that's amazing at getting people into debt, but terrible at helping them get out of it. The numbers we've discussed today about 1.5 trillion in private credit, 390% annual interest rates in some cases, they're not just statistics.
They're real people's lives being affected. And it seems like younger generations are bearing the brunt of it.
Exactly. The evolution of these debt traps represents something bigger than just predatory lending. It's showing us how financial innovation can actually make things worse when profit becomes more important than people.
So, what's the takeaway for our listeners? I mean, this is pretty heavy stuff.
I think the key is understanding that we're not just talking about personal finance anymore. These debt traps are reshaping our entire economic future. And unless we start having serious conversations about regulation and reform, we might be heading toward another financial crisis.
One that could make 2008 look tame by comparison?
That's what keeps me up at night. When the line between innovation and predation becomes this blurry, we're all at risk. The real question isn't just how we got here, it's how we find our way out.
Thanks for listening. Don't forget to share it with your friends. See you next time.